I want to provide a brief introduction to the concept of options. Now, what is an option? Now, options give the holder the right but not the obligation, that is, literally the option to do something. Examples of options in real life are a rain check in a store. If you go into a store and they don't have the item that's on sale, oftentimes they'll give you a rain check, which means that you can come back at a later date when the store has it in stock and still buy it at the sale price. Now, do you have to use that rain check? No. If you find it at a cheaper price somewhere else, you can just throw the rain check away. But if it's valuable to do so, the sale is very good, the price is very good, you can't find it cheaper anywhere else, you may choose to exercise that option and come back and use it to purchase that item at the sale price. An auto insurance policy is an option. Say you get into a little fender bender. Do you have to file a claim with the insurance company? Well, no. You file a claim if it's financially valuable for you to do so. Suppose you realize the insurance company is just going to give you a few dollars for the repairs. You figure it's going to be a hassle to file the claim, the insurance company is probably going to raise your rates, so you choose not to exercise that option. You might also have a professor who makes the final exam optional. So maybe you have an A in the class, you decide, look, I already have an A in the class, I don't have to take the final exam. On the other hand, maybe you have a B in the class, you'd like to get an A, I'm going to take the final exam and try and improve my grade. So here again, you're holding an option. Now, when we think of options, usually we talk about stock options. Stock options give the holder the right but not the obligation to buy. If they have the right to buy, we call that a call option, or the right to sell, and if it's the right to sell, we call that a put option, a stock at a specific price during a specific time period. Now, that specific price that you can buy or sell at is called the strike or the exercise price. You also have a premium, which is the price you pay to purchase this option. In fact, that's the same term that we use in auto insurance or any kind of insurance. You pay a premium. So that makes it a little easier to remember. Options are sometimes referred to as derivative securities because they derive their value from some underlying asset. Okay? Unlike a stock or a bond where the value of the asset is the future cash flows, the option gets its value from the asset that you can buy or sell. So let's look at an example. Suppose we use a notation where S is equal to the stock price and E is equal to the exercise price. I have a little table here. For a call option, we say that the option is in the money if the stock price is greater than the exercise price. That is, if the price you can buy it for, E, is actually lower than the price it's actually selling for, then it's valuable. This is the case where you go to the store and the stereo, that $1,000 stereo is on sale for $400. Right? You know it sells for $1,000. You have this rain check that allows you to buy for $400. That's the exercise price. It's in the money. It's a valuable option. The option is out of the money, the call option is out of the money if the stock price is less than the exercise price. Why would you want to buy at the exercise price E, say it's $50 a share, if the stock is only selling for $35 a share? If you want the stock, just call your broker up and buy it for $35 a share. There's no reason to use the option to buy it for $50. And we say it's at the money if the two are equal. For a put option, remember a put option gives you the right to sell. So you want the exercise price, the sell price, to be greater than the market price of the stock S. So if the exercise price is 50 and the stock price is 25, you'll be able to sell a stock that only is worth $25, you'll be able to sell it for 50. Of course, it's out of the money if the exercise price is less than the stock price, because this is the case where you'd be selling it for less than you could sell it in the open market. And again, if you wanted to sell it in the open market, if the price in the market is $75 and the exercise price is $25, why sell it for 25 when you can sell it for 75? And of course, if the two are equal, again, we say it's at the money. Let's take a look at a payoff graph here. Now, normally we show this little hockey stick picture. I drew in this little red line to show you the 2 points of out of the money and in the money, but normally you don't see this. Now, here, what I have on the x-axis is the stock price, and up here on the y-axis, I have the profit. So in the case of owning a call option, you pay a certain premium, so that's the vertical distance here, and as long as the stock price is less than the exercise price, it doesn't make any sense to buy it at the exercise price. Right? The exercise price is 50, the stock price is 20. There's no reason for you to pay 50 to buy the stock when you can call your broker up and buy it for 20. So in this case, you just have this flat line. There's no money being made. All that happens is you lose the premium. Now, for every dollar the price goes above the exercise price, you actually make $1 on the option, and you'll break even right here. So the price has to rise enough to cover the cost of the premium. And I have this line, it goes up at a 45-degree angle, and it actually has an arrow here because there's literally no limit as to how high the price of the stock can go. If the stock price is greater than the exercise price, you're in the money. That's when this turns up and goes up. All right, over here, you're out of the money. And of course, right here, where the stock price equals the exercise price, you're at the money. Let's take a look at what the payoff for writing or selling a call option would look like. It's a mirror image. We call this a zero-sum game. That is, whatever money the option buyer makes, that comes from the person who sold the option. Now, this is flipped over because the person who sold the option receives the premium. You can think of the insurance company. They receive the premium. Now, as long as the stock price is less than the exercise price, we saw that the person who held the option, who owned the call option, isn't going to use it, so you get to keep the premium. Again, for every dollar it goes above the exercise price, you lose $1 because you have to pay that dollar over to the person you sold the call option to. That is, you have to sell the stock to them for $50, even though the stock is selling for $52 a share. So you're losing $2. Okay, and over here, as it keeps going, and again the arrow points down because there's no limit to how much money you could lose, because the stock price could theoretically go to infinity. What's the payoff for owning a put look like? Now, a put lets you sell at the exercise price. So if the stock price is high, you don't want to use the put option. You simply lose the premium. That's why you have this distance here. That's the amount you paid for buying the put option. And you just lose that. It's just a flat line here. Once you get to the exercise price, for every dollar the stock price goes below the exercise price, you make $1. So if the exercise price is 50 and the stock price is 40, you're able to buy the stock at 40 and sell it to somebody for 50. So you make a $10 profit, less whatever premium you paid for. So here again, in the money is the case where the exercise price is greater than the stock price. The selling price, the price that you can force someone to pay you for the stock, is greater than the price that's selling for in the marketplace, S. It's out of the money if the exercise price is less than the stock price. And of course, as I said before, when the exercise price and the stock price are equal, you're at the money. Okay. Again, for writing a put, you have sort of this mirror image, so that when the put is out of the money, it's not being used, and you as the writer of the put get to keep the premium. Once you hit the exercise price, for every dollar it falls below that, you lose $1. Okay, so in this range here, you're in the money, here you're out of the money, and right here you're at the money. How do you value options? Again, I mentioned before, in stocks and bonds, we find their value by taking the present value of the future cash flows. Well, options don't have cash flows, So we use a different approach. The value is based on the principle of arbitrage. And the idea of arbitrage is that identical things should have identical prices. Now, it's a little beyond the scope of this video. I have some other videos where I show you some of the pricing models. But let me just tell you intuitively here. The approach is to combine buying the stock with selling the call option to create a riskless portfolio. Now, if you've created a portfolio that's riskless, then it should earn the risk-free rate of return. And what you'll do is you'll solve for the option price that allows the riskless portfolio to earn the risk-free rate. All right, there are a couple of models, or there are more complicated ones, but the simpler ones you see are the binomial option pricing model and the Black-Scholes option pricing model. I have videos that cover both of those. Let me just finish up by just mentioning some of the factors that determine the value of an option. Okay, the stock price, not some future stock price, but actually the current stock price, the exercise or strike price, the time until the option expires. Now here you think about, the longer it is before your option expires, the more value your option should have, whether it's a put or a call option. If you've just renewed your auto insurance and you have a year before it expires, it's a lot more valuable than an auto insurance policy that's going to expire tomorrow, right? Because you have a lot of days of coverage. The risk-free rate of interest comes into play, and also the volatility of the stock's returns. Normally, we don't like volatility, but in the case of an option, we do, because of that, the fact that you only use it if it's good for you. So you really like the stock to go way up or way down. If it goes way up and it's in the money, you use it and it's valuable. If it goes way down, the most it happens is you lose the premium in the case of a call option. So you actually like volatility for both a put and a call. So if you'd like, I'll post the links to the binomial and the Black-Scholes option pricing models, but here I just wanted to introduce the concept of an option.